we've got three big silos of interests here being represented. There are the short sellers, there's social media, and then there's retail. Is there one, do you think, that's truly going to be at the center of this hearing?
I actually think that we should focus on the integrity of the markets themselves and not so much on winners and losers in the GameStop trade. There is a target-rich environment. I think my colleague would agree. There are a lot of moving parts here. But what I'm centrally concerned about is the fact that, during the run-up of GameStop's, price dislocation, you had Robinhood, in a position where there seemed to be a liquidity problem. They actually had to stop. They suspended trading and put their retail customers at enormous risk. And I'm just wondering what would have happened if there were wider volatility in the market and there wasn't someone like Citadel to come in and rescue them. What if we had liquidity problems wider in the market and you had a major brokerage firm suffer a catastrophic collapse? Could that reverberate through the system itself? So I'm worried about that. And I'm also worried about, look, our adversaries learned a lot about the vulnerabilities of our markets back there during the GameStop debacle. So is there a way that these trolls in Russia could do the same thing they're doing with misinformation on the political side, but use that to disrupt and undermine the integrity of our financial markets? That's a real possibility, but we'll learn more about that today.
Yeah, there's certainly a lot of the issues you're raising were big questions in the early days of that squeeze. Congressman Barr, in an era in which there seems to be no issue that is even remotely bipartisan, does this one at least get in the ballpark?
Well, I hope so, and I hope that this hearing is more about an impartial fact-finding exercise as opposed to political grandstanding or an effort to justify excessive government interventions in ways that would actually harm investors. I think there is going to be undue scrutiny of payment for order flow in this hearing. I think there's going to be undue scrutiny of short selling when, of course, we know short selling is an important part of hedging. It's an important part of the capital markets, the proper and efficient functioning of the markets in terms of price discovery and the provision of liquidity. I hope that the scrutiny of payment for order flow doesn't end up leading to an overreaction by regulators to undermine the democratization of access to the capital markets. We've seen great innovation with Robinhood and other online trading platforms to give retail investors access to the capital markets, to expand participation in saving and investing. That is a good thing. We should celebrate that. And volatility in a handful of stocks that didn't have any systemic impact in terms of the broader markets should not be a justification or a predicate for an overreaction by regulators.
Congressman Lynch, do you agree with that? Do you think that there is a risk of going too far in terms of, regulating more transparency, especially around that payment for order flow?
I would say I need to know more to judge that. I am concerned about the pay for order flow model and the aspect of our retail customers getting the best price. Because there does seem to be a lack of transparency there. I know that the brokerage firms have to file 604, 605 forms, but those are once a year or when you open your account. So there's no way that a retail or there's very little way that a retail investor can find out if they got the best price and what the margin was. Is this, are we getting the national best offer or is the margin significant that the retail customers is losing out here? So is this the best execution under this model? And how much advantage is being taken of the retail investor under these circumstances? I do agree that, we want to encourage people into the market. We all love the idea of the democratization of the markets and zero commissions, but it's not free. There's a cost here, and we're trying to figure out what that cost really is.
Congressman Barr, good morning. It's John Ford. I want to press on that democratization idea because it seems to me there's a difference between investing and day trading. And when it comes to access to capital markets, are apps like Robinhood really encouraging saving and investing, or are they encouraging the gamification of trading? Do you see a difference, and do there need to be perhaps different incentives given for the way this gets rolled out to new investors?
John, that's a good question. And what I would say is that you can't legislate valuation. And investors should be free to take risks. That's what the market is all about. Investors should be free to trade as they see fit. And they have the freedom to be wrong. And I think you're seeing market discipline set in here. No, there shouldn't be gamification of the markets, but I think market discipline is setting in when you see retail investors who get in late in this rally and where GameStop pricing is so gets so far away from fundamentals and valuation that retail investors learn a very painful lesson. That market discipline will set in. And I think at the same time, these professional hedge fund investors are learning what democratization actually means in terms of the risk of short squeezes. And so I think that this episode is actually a teaching moment for many market participants.
Shepard Smith here. Thanks for watching CNBC on YouTube.